Good evening, ladies and gentlemen. Today we have a webinar. It's my first webinar for Israeli people, for Israeli investors, and the topic of today's webinar is the current state of the United States market and the strategies that are working today. Before I start, I want to say a couple of words about myself. I give a little history of my career on Wall Street. So this way you'll be understanding who you are dealing with, and you will see that I have enough expertise to show, and that I have a lot of achievements that I can show you, that I can tell you about. And the purpose of it, not to just tell you about my achievements. I just want to share with you some of my visions, some of my experience with this market, and I hope this will help you in your way to become a successful trader. So I started my career back in 1994 after graduation from the Columbia University, where I got my MBA. And I came to Wall Street back in August of 1994. So now it's my 25th year on Wall Street. So during these years, it's 25-year career. During these years, I worked as a portfolio manager, as a trader, as an analyst, and I did day trading. I did long-term investing. I did some advising. I was managing some people portfolios, and that's what I'm doing right now. I basically day trade, I invest, and I consult people. I have some programs, some educating programs where I teach people how to trade, when I help them to go through the fundamental analysis, technical analysis, and I help them to succeed in this difficult market. So what's the most essential in my career that I can say? It's my experience as a portfolio manager. Because being a portfolio manager is kind of experience where you learn how to deal with the stocks. You deal with the stocks on daily basis. You optimize your portfolio every day. So you just look at the stocks and you understand why the stocks are going up, and you understand why the stocks are going down. So when the earnings report comes, I know that a lot of portfolio managers will be looking at it. If it's a positive report, a lot of portfolio managers will be looking at the stock, and they will be trying to buy it. And I know for a fact that after a good earnings report, when it's really good, the stock goes up for about like 2 to 3 months period. And the same way when the report is bad, and when everyone dislikes the stocks start falling, and fall usually lasts a little longer than the rise, because people just getting out slowly, and some people are not realizing that it's time to get out before it's too late. And when you short the stock after the bad report, it's always like more rewarding, because you can make more money. Another part of my experience that I want to share with you is the experience of being a day trader. Like, I understand that most of you, the guys that that I spoke to some of you, then that some of you saw my calls, my messages. Most of you guys, like, I understand you are day traders, so you are looking to make money on a short run, so you're on a short span of time. So like from your posts, I just realized that you're looking at the stocks where the volume shows some new stocks, but most of the time, like I saw, it's a small, very small companies that I really don't pay attention to, because being a portfolio manager, I was taught not to deal with the stocks under $5, because I am belong to the old school, and the old school teaches you that you have to be where the big money are. So the big money are the portfolio managers, pension funds, hedge funds. Those are people who make difference in this market, because when those people are willing to buy, when they're willing to commit their clients' money, that's the time when the stock is going higher. And sometimes I post those stocks, and that you should understand that they're expensive. And those stocks are really the ones that I'm making most of my money from. And to tell you the truth, that most of my money were made in the past, because in the past, the market was more rewarding and it was easier to succeed. So I came as a day trader. I came to after being like portfolio manager, after being fixed income vice president at Morgan Stanley. I came to day trading because I realized that day trading at the time, it was the beginning of 2000. It was the area where you can make a lot of money. And matter of fact, I was working for the company named WorldCo that was in New York. The company was in New York City. Matter of fact, there were some Israelis working in this company, and the guy who started this business, his name was Walter Bruin, and he was one of the most brilliant people in this business because he saw that you can make a lot of money in this area, and he was very successful hiring the best talent on the street. And there were a lot of young and bright people that I met during my tenure with this company. I was with Worldco for about 4 years, and during this period of time, I was like in the top 20 of the traders considering making money. And I worked with the guys like Alex Gerchik, who some of you probably heard about. I worked with Dave Perot and Eugene Kolnick. There were a lot of talented guys. And I can tell you that most of those guys, that of the top 20, if I'm talking about those guys, about like 18 of them, maybe two of them, including myself, still in business. The other guys, they just made a lot of money in those years, like starting from 1998 until 2003. And then they just started doing other things. They just invested in real estate. They started doing some IT business and other things. But most of those guys are not on Wall Street anymore. They're not trading. Most of those guys, they just realized that the best times were over. So, and you should, as a traders, you should also realize that there are good times to make money and there are bad times when you can lose money. What I call the good times is the times with the high volatility. Volatility, this is an indicator that shows the fear of investors. The volatility shows that the market's range increases. That the range that the stock have during the high volatility times also increases. And the time, for example, if the stocks during the quiet period of time when the volatility is under 15, and if it's even under 10, that it was like in 2017, 2016, when the volatility really goes down, the ranges of the stock trading are really goes down, and it's harder to make money. I hope the most of you noticed that. And when the volatility goes up, like it was in 2016, when there was an oil crisis, when the oil prices went under 26, and 2018, when there was a time when the whole market went down and some stocks corrected 20, 30%, even more, there was a time when a lot of money could be made. And I can tell you that from my experience, that the best years that I made money on day trading were year 2000, year 2008, 2009, when there was a crisis. And then there was a time when a little bit of money was made. It was 2011, 2016, and of course 2014. And if you're an investor, the best time to make money is during the exit out of the crisis. When the crisis is over, when you realize that the market is not going down any longer, and you can basically invest in any kind of company if it's like you using your common sense. And if you buy just any company, technological company or industrial company, you can be sure that 9 out of 10 companies will go up. And this was the best time for investing. There was 2009, exactly when the crisis ended, was March of 2009, when I put a lot of money in my portfolio, and I invested in a lot of technology stocks, financial stocks, and I made a lot of money. It was 2009. And matter of fact, I still hold some of those stocks from from that period. And right now, for example, 2019, 2018 and 2019 was an excellent time to pick up some oversold names, something like SWKS. I will quote those stocks. For example, SWKS, the stock which was sold at $64. Right now, the stock is in 80s. and it was $87, and you could make basically like 30, like 40%. Most of the stock rebounded pretty well, and this was the best time actually to make money, because when you are trying to buy stocks during the high of the market, right now we are 1.5, maybe a little bit less percent away from the September high. This was absolute market high. And if you're trying to buy something right now, of course you will have a hard time, because you are like the market is floating near its high. A lot of negativity is going around, and it's actually very, very hard to make money. It's there is a time when it's worth to get in the market with a lot of money, and it's a time when it's better to stay away and observe market and wait for your time. So because I think there are two most important things in the market that I learned over the 25-year span. Is first very important thing is to determine what is the market doing right now. And today I will be talking a lot about that, to determine like what the market is doing and what the market will be doing in the near future, to understand what the market wants to do, because you don't want to be caught by surprise and lose a lot of money during the sell-off. So you don't want to be caught by that. So you better off to put your capital to work when the market is out of the crisis, like after the sell-off is over. After the sell-off is over, you better off putting your money to work. And right now, it's the best way just to look at the market to see when the sell-off is starting, maybe just to short a little bit, because I notice you like buying most of the time, you're not shorting the stocks. But I learned that shorting is also very good, but not shorting the stocks, the single stocks, but the best way is to short the entire market. So, and I will show you how. So before we continue, I just want you to write your questions. If you have any questions that you will have over my webinar, if you will have some questions or you want to clarify on something, just write your questions on this page. On this page where we will communicating, I will be looking at this page for questions, and I will be answering them after I'm done. All right. Then another thing I want to mention, I just said that's important to figure out what's market doing right now. And the second most important thing, to select the right stock. So, and I will be talking about it today also. So, all right. So we are in this market to make money. We're all here to make money. Some of you want to make quick money, like you finding like the stock on for example, on the news, the stock that's like receive FDA approval, or the stock which failed to receive FDA approval, or the stock that's like, let's say, got a new product, or the stock that reported good earnings, or the stock that, for example, got upgraded, or their price target got upgraded. And all of the stocks are on the news and they are in play. I call those stocks in play. All of those stocks could be found at briefing.com. You can find those stocks. You can basically try to catch the movement on the stocks, like $1 or $2, or I don't know, whatever you want to catch, depending like on the amount of shares you just making a trade. You can buy like 10,000 shares, make 20 cents. It's like gonna be like $2,000. You can buy, let's say, 1,000 shares and make $1. It's also gonna be $1,000. So you can like actually measure your risks and get into position based on your expectation. Every trade has met expectation. There is a statistical term called met expectation. So whenever you get in a trade, you have something in your mind. You have like certain amount of money that you want to make, certain like movement you have in your head. You hope that the stock will go like 100 points, like 10 points. But your expectation, I bet they're realistic. So you all have realistic expectations, and you get in the stock. And when your expectations are not met, when you see you got into the stock and you're seeing the stock is going against you, you have to actually put like a sell stop in place, because the sell stop is actually your risk you're willing to put down, how much money you're willing to put down on this trade, and that you are not willing to lose more than that. For example, you bought stock at $20, the stock is in the good news, you're willing to make like $1, but you better off not losing more than 30 cents in that stock, because What you should really do, you should 1 to 3. So for example, if you want to make $1, you could risk only 30 cents. So you're better off putting a sell stop with 30 cents at 1970. 1970, 30 cents, that's all you want to lose. But the bet part, and I will not surprise you with that, you probably all know about that. Whenever you trade, you're fighting with algorithms. You're fighting with algorithmic programs who really used a lot of parameters. They're using, some of them are using up to 200 parameters. And one of those parameters are human psychology. And they understand where people putting their stops, and they're going after those stops because algorithms, they're willing to make money. And you can understand that yourself is fighting against you. So there are like people who are better than you, smarter than you, they're fighting against you. And in order to beat those people, you have to be ahead of them or you have to be on their side. But the problem is that those people are willing to make those teeny movements. They want, for example, when you are willing, let's say, to go up with 500 shares and make, let's say, 20 cents in order to make $100, those people are happy with 5 cents. So what they do, they're not letting your stock to go your way, so they just create the, this chaotic movement. So they create chaos. So they create chaos in which it's very hard for you to exist. And the stocks are moving so fast that sometimes when you're willing to put a stop, the stocks is already going like going against you, even in the more, let's say you put like sell stop at 1970. By the time you're putting the stop, stocks is already trading like 1950. So what it is, though, those algorithms, they faster, they smarter than you, they smarter than me, because with all my 25 years experience, I already don't have this kind of reaction. Let's say the 20-year-old have, but you see even the 20-year-old traders, the smart guys, the brilliant guys, it's very hard for them to make money unless they taking enough risk, unless they just really putting their stops behind those algorithms reach. So they're putting their stops at not in 1970. They're not even putting their stops at all, because all I can assure you that all of those small stops, they accumulating, because you're losing 30 cents there, 20 cents here, and on 500 shares, you're losing those money, and this accumulates. You're paying commissions also, and those losses are accumulating. They tend to accumulate, and I can assure you, because when I traded back in 1999, 2000, 2001, I used to pay about 1 cent per share on commissions, and I used to trade about 100,000, 200,000 shares a day, and I was only paying on commissions like 1,500, sometimes $2,000. And in order to take something home, I had to make more than that. So I had to make like $5,000, $4,000 in order to take something home. So, and I know how those losses, small losses, accumulating. And when you lose money on the trade, in order to get profit, you have to cover those losses. You have to take back those losses. You have to make money. If you lost $30, first of all, you have to make this $30 back before you make anything else. So this way, it's I can assure you that day trading right now is not day trading as it was back in the 2000, in the early 2000. It's not the same business. It's all started to get bad. It's all started to spoil when the short selling rules was canceled. You probably, most of you are not remembering that, but I can tell you, when I started day trade back in 2000, in order to trade the stock, you needed an uptick. So the uptick is like the minimum increment of movement. That's 1 cent. For example, if the stock trades at $20.50, in order to short the stock, you have to offer it at $20.51. So you have to short the stock at a penny higher, whereas compared to where is stock trading right now. So, and we were dealing with the situation by buying bullets. Bullets were the instruments that was allowing us to short the stock without downtick. So we could simply sell the stock, and if we were identifying this short seller in the stock and we were selling ahead of them, then we were making good money. But then all those rules were canceled, and market became like a chaotic place. The market became like I don't know, like something crazy, and a lot of people left the business. I can tell you that back in 2001, our company WorldCo had about 800 traders, and in 2003 there were only 180 traders left, and in the same year, 2003, the company was closed because they had some legal issues, and many traders were leaving, and the company just closed down. And then I considering that time the end of the day trading, because the day trading really started back in 1997. It started because of the internet era, because a lot of people started having computers at their house. There were some day trading companies appeared who were willing to give capital to the talented traders. There was some new like those day trading companies, and the stocks. The most important thing that the stock had the movements. There was the stock that we're trading at that time was like Juniper Networks, GLW, Intel, Microsoft, Cisco, and there were like a bunch of companies, technology companies that were moving pretty well. They had the day range, and you could make good money because back then the bid was meaning a bid. If you saw, for example, 5,000 shares on the bid, you knew it was real. You knew there was a real buyer, and you knew that this guy would be there. He will be there until he fulfill his order. You know that you could identify real buyers and sellers, and there was a specialist book to our usage that we could look at, and where we could see a different level of interest, where we could see that the one buyer is, let's say, at $50, another buyer it's $49.80, and you can see that the advantage was on the buyer side, and you could figure out that the stock is definitely going higher. And I'm telling you, it was like very easy. If I got back to that to those days when the market, when the day trading was such as I'm telling you, I would be making like millions. I would be making like a millions of dollars. I can tell you also that during that time, I was able to control my losses, and I was like maybe like 85% of the days I was positive. I was making money, like I can tell you, like 85% of the time. And whenever I was losing, I was controlling my losses, and I was not letting myself to lose more than, let's say, $1,000 per day. So this was a time when you could control your losses, that you can make real money, like by making gains. And this was a very, very good time that I'm really missing, and a lot of my friends, my trader friends, they're missing that too. But still, we are existing. It's a 21st century. We're existing in a different reality. We're existing like with algorithmic trading, with hedge funds who are trying to screw us up. We're existing in the news when, for example, the brokerage comes with upgrade. When they give an upgrade to a stock, we know that the stock is open higher, but for some reason the stock doesn't go higher any after that. So the stock just opens with a $2 gap, then it comes back like to $1 down, and then maybe floats for the rest of the day. So it's really, really hard to make money based on a specialist calls right now, because on a broker's calls, because brokers are really trying to trick you. They're trying, when they upgrade the stocks, they're letting their clients to get out. When they downgrade stocks, they're trying to buy stock cheap. So they're trying to screw you. They're trying to take your money, because a lot of hedge funds are out of the business. Actually, the year 2018 and the year 2017 were the worst days for hedge funds, and a lot of friends of mine who had their hedge funds, they closed because they were not able to make money. They were not able to make money, and they were not able to bring the new clients, to show them the good record. So they were not able to make money, so they closed down. So we have to exist in this reality. So I don't want to sound very pessimistic, but I want to tell you the truth, because the truth is the only thing that counts. Because if you know really where you're existing, so this is like the way it helps you. This helps you to survive. So I can tell you another one wisdom that I really agree with, and I think this will help you also to survive in this market. The thing is that the money, Wall Street is a business. When the money going from impatient investors to the patient investors, because if you're patient enough, you can survive. You can really hold the stock. You can really average down if the stock goes against you. If you really understand like what the stock is doing, you understand the business of the company, you can read the financial reports, You can research their earnings, and you can see that the stock is good and it's just falling just temporarily for no reason. You can accumulate the stock and make good money. So I will show you a couple of stocks that's really on its way on its way up. The stocks that really strong, and the stock that I really hold, and the stock you could make money. And I will show you. You've probably seen a lot of stocks that went like 600%, 500% up this year and the last year, and I will explain you how to identify those stocks and how to really make money on the stocks. The first stock I want to start with is a company called TWLO. TWLO. I will not go into technicals. I will not go into fundamental analysis. I just tell you that this stock is up, and the stock is up from 37 to 136 at its high. It's like 4 times, like 3.5 times, let's say 4 times, 400%. The stock is up. So what differs the stocks that I will show you? For example, I can refer here to SQ, to TTD, like the stocks like TTD. Uh, 1 second. TT, not AT&T, the stock like TTD. This is a stock which is advertising company. They provide instrument for digital advertising. And the stock we can see went up from 47 to 214, almost 5 times. So it's like 500%, 400%. So what's in common between those stocks, and why the stocks are going higher? So in order to identify those stocks, you really have to understand the nature of their business, and you can see, and really like what's in common. Those stocks have their advantage, their competitive advantage. Those stocks have a unique product. So the product is unique, and this product makes the life of businesses easier and more efficient. For example, the company like TTD allows company to have a nice advertising campaign, probably allows them to save money, to allows them to run this campaign more efficient, and as a result to make more money. So this company actually makes money. What makes this company different from the all other companies? The fact that this company makes money. We look at the analysis, and we see that this company beat the in the previous report. They beat estimate by 30 cents. One before that, they beat by 15 cents, by 16 cents, and by 24 cents. 4 out of 4 reports, the company showed better result than expected. Matter of fact, we see also that the company is profitable, right? And their profit this year will go up from 255 to 329. The profit will go up by nearly more than 70 cents. So it's like almost 30%. The profit will grow 30%. It's something like Amazon in the early days. But Amazon was unprofitable. This company is profitable. The only thing that really alerts me that the fact that the company lowered their estimates after the probably after their last earning report. They lowered the estimates by 20 cents for the current year and by 14 cents for the next year. But this really doesn't make sense to me, because the company beat estimates by 30 cents, and I don't know. I don't think it's the right thing. So sometimes those sites like Yahoo Finance and other sites that you're looking at, they're showing you some kind of controversial things, and you have to really look at it and try to figure out maybe something is wrong. For example, company like TWLO, this is like a cloud company, one of those cloud companies, like I call them. The company that really had a lot of pessimism in early years. We can look that this company was floating for a long time around $25. If you look for 5 years history of the stock, we can see that the stock was like around $25, $30 for the extended period of time from 2016 2018. For 2 years, the stock was accumulated before it went before it made like a nice jump. So what's common before the uniqueness of their business, before their niche, before the other thing is those companies have no competitors, so they have their unique their unique business and no competition within the near future. So the other thing that those companies, if even they're not making money, if they're not profitable, their sales are growing at a rate of 20% a year plus. 20, sometimes 30, sometimes 40%. So they basically trying to grow their sales. So that's how they just do business. So they buy the competitors, they buy the smaller companies, and they trying to grow their sales. They trying to grow their sales, and then once they reach a certain level, they can lower their expenses and they can work on their earnings. So it's always works like that. And those companies are the ones that went over $100. I can assure that those companies will be here for a long, long time. The only thing that could happen that the big ones like Google or Amazon, they could buy those companies in order not to compete against them. They could buy them, but for you, for me, if you are not in those stocks, it's a little bit too late because if you look at those stocks, we can say, listen, this stock was like 25, $30. Now it's 122. How long? How more the stock can go? Could it go to 200 or to 300? It might go there. It might go there very fast. I can show you another company. It's called MDB, Mongo database. So this company is trying to compete with Oracle. Oracle has a linear database with lines and columns. This company tried to introduce a non-linear database, which has actually a lot of sense. And I don't know how this thing will be in the future because there are a lot of other companies that providing similar things that providing it for free. But we know that those companies like CRM, like Salesforce, like many companies like that, who the street was selling, those companies are not making money. But all of a sudden, we saw those stocks like at the $200 level, and we realized that we were like the street realized that they were wrong about those companies. If we look at the company like MDB, for example, we see that this company is not making money. Even the next year, like this company is in the year 2020, they're losing $1, and next year they will be losing 68 cents. The company is still losing money, but if you look at their sales, we see their sales are growing like 120 million the next year, and it's like 30%. So this is what the street likes. So street likes the uniqueness of the product. They likes the rise of their sales, and if the company reach profitability at a certain period of time, it's going to give even bigger boost to their price. So that's what it is. And basically, what I'm trying to do, I am trying to search and find the stocks who are in the early stage of their development. For example, it is hard right now when market is overvalued, as I consider it overvalued. It is very hard to find the cheap stock which can grow like that, like which could grow like 500, 400%. It is hard, but right now, when I realize I have an investment in some of those companies, but right now I am back to the basics when I want to invest in real value, because right now over the last, let's say, 16 years, there was only 1 year when the value stocks outperform the growth stocks. The stocks like MDB, like TTD, like the ones that I showed you right now, those companies are the growth stocks. They provide you with the growth story, with the rising sales, with the rising market share. And the stocks that I consider value, those are the stocks that are trading with a really modest valuation, with PE, with the price to earnings ratio under, let's say, 15. Uh, to find those kind of stocks, it's not hard. I really finding those stocks because I can show you the filter that helps me to find those stocks. But those stocks are really like the stocks to hold for a near future. I can tell you that market went through the, like, when I was in the market went through different appreciations. There were different bubbles in the market, and you probably, whoever is a long time in this market, they remember those days. First of all, there were Nifty 50s. It was a 50 stocks back in the 70s. They were mostly like consumer product stocks that were, I don't know, for some reason they were liked by investors. There were stocks like Kellogg, Colgate, like I don't know, Walmart and others. There were the stocks, consumer products, department stores, and the investors liked those stocks and they were going higher. Then there was a time that I remember, there was a time for technology companies. The stocks like Cisco, Intel, Microsoft, and many others. Oracle, of course, I can mention Apple. Apple, like starting like from 2000s when the Apple iPhone was introduced. Those were like the stocks which I still considering a good way to invest. For example, if you look at the stocks like Intel, which is I don't know, right now it has a huge competition with AMD. Intel stock, I consider it with the Pentium chip. It's like a number one semiconductor company, right? Because semiconductor sector that I know pretty well. I've been trading semiconductors all this period of time from 2000 until now. And semiconductors are very interesting area because semiconductors are the first coming out of crisis. The companies that's going up start going up first are the semiconductors. And semiconductors are the companies that provide you with various opportunities because there are companies that make the equipment for semiconductor productions. There are companies who make semiconductors for, let's say, consumer products, company that makes semiconductors for Internet of Things, for virtual reality, and there are many, many, many semiconductor companies. And the story with a company like AMD, I know many probably appreciate this stock because company went. First of all, it went from $70 to $2, and it went from $2 to $35, and from $35 to $18. Now it's back to $27. And I have my own site, and I was recommending this stock when it was $18. I was saying that this stock has a 50% up potential, and the stock totally lived to my expectation, and now it's like 27.49 from $18. It went up exactly 50%. Like I mentioned, like stocks like Microsoft, like Intel, Cisco, those are the stocks that give you a gradual appreciation of your portfolio. For example, if you take a portfolio of those three stocks like Intel, Microsoft, and Cisco, I consider them the top three in the companies that's really traded nice valuations. Those company gave you like 30% if you like taking if you invested in those stocks, let's say a year before, you would be making like 30%. So 30%, it's a nice increase, giving like the market was very modest, gave you a very modest return in 2018. So the stocks gave you a nice return, but most of the return came after 2019. So first it started with January effect in January of 2019, and the stocks are going higher still. They're going higher and they're going higher almost every day. Even today, when we see like all the indices are down, most of the stocks are still up. Those technology companies, those the high flyers. If you look, like say Apple is still up. Like we're looking at the Nasdaq, where Apple has a largest share, largest weight in the Nasdaq index, and Nasdaq is down and Apple is up. So it's a lot of times right now when the common sense is not working. So because there are certain areas that are up, certain areas that are down. You can look at the FinVs, or you can look at the similar services, and you can look which are the strong stocks today, which are the weak stocks today. When I look at this thing, like every day I look at those indices and I made my conclusions. Today I see that the Dow, S&P are the mostly down. Russell 2000 also is down 42.42%. So it tells me that those stocks are the most down today. So it's probably, though it's industrial stocks, so industrial companies which are part of the Dow, probably there is a company that's lagging the market, that's dragging the market down. S&P, the index of the financial companies, also down. But we see the best of all is Nasdaq, which is only down 0.29%. It means that those all like high flyers and Nasdaq stocks, they're like up today. So that's why we can see that today, the day for the technology companies. And I can see that probably there is no time for the sell-off yet, no time for the correction yet, and we will be talking about it right now. Let's talk about the market and market potential for the next, let's say, year or maybe a little bit longer. So the thing that I mentioned, like probably most of you saw that inversion of the rate curve when the 3 months bonds were paying you higher than the 10-year bonds. So it means that investors don't want to take the longer risk, so they don't want to take shorter risk, and normally, when that happens, it's just a warning about the coming recession. So normally, when and it happened in the last, let's say, three instances, when the a curve inversion occurs, the recession happens after 18 months after that. So we can expect, in many strategies, they saying that the recession in the United States will probably start like sometime in 2020, maybe 2021. And the recession, it's two quarters of the lower profits, 2 quarters of the GDP reduction of the GDP. When GDP goes down for 2 quarters in a row, it's also called the recession. And the recession will, when the recession occurs, the market will definitely go down. And right now, we actually 1.3, 1.4% away from the, maybe not right now, about 1.5% away from the September high. And some people, they think that the market might go like over 3,000 on S&P, and with following with all the other indices to follow, with Nasdaq and Dow. And this year is it's like looking to be like one of the best years in a long period of time. So this year S&P is already up like 15%, like 15%, and if the market will be able to hold to 15% figure, then it means that it will be one of the best years for the market. I don't know when was the last year so good. I don't remember. Maybe like something in 2013, 2014, maybe 2012. Those were like one of the better years. But market is looking to make good gains. And right now, when I look at this market, I see that market doesn't want to fall. So maybe it doesn't want to fall for the reason because people are realizing if you blink, it will others will also blink, and the market will go lower. We might experience something like we had in 2018, in December of 2018, when all the stocks all of a sudden they went down. First of all, it started with like industrial stock, then it started with chemical stocks, then retail stocks joined, then all the technology stocks joined, and all of a sudden, all of the market went down, and it didn't. It just ended up to be down like 19.8%, and there was like two tenth of the percent. It was two tenth of the percent. Well, not to making it like a bear market. So bear market, it's when the market falls 20%. Matter of fact, S&P is considered for that purpose, but Nasdaq fell more than 20%, and Russell fell more than 20%, but S&P was able to hold, and that didn't make the market to make it bear market. And as you all know, that Federal Reserve was coping, and Powell said that they will not raise interest rates in 2019. They said everything is fine, and that helped the market very well also. But right now, we're having April quarter coming. So April quarter starts like already this Friday, and first we'll see the banks reporting. Banks are reporting always first, then they joined by industrial companies, and then all the rest of the S&P members reporting. So right now, the expectations for this quarter have been lowered even the last week. Like right now, if we compare this quarter to the April quarter of 2018, we're expecting 4.2% reduction in earnings. 4.2. Just about 1 week ago, it was 3.94%. Now it's 4.2%. So we will see a reduction in earnings. But all of those expectations are already built in the stock prices. Because if you look, a lot of companies during the January quarter, they lowered their expectations and they fell. And for example, when companies like NVIDIA, the company which lowered their expectation, we can look at it, just simple example that market is a little bit manipulated. Nvidia is a company that we all heard about it, the company which was like back in 2016, the company was $37. And when the Bitcoin mania started, the chips, the video cards, I'm sorry, were bought in order to mine those Bitcoins, and this company benefited from that. And right now, if we look at the company estimates, Nvidia analysts still recommending us to buy this company. We'll see that, for example, 90 days ago, the expectations for the current year were $7.17. Right now, they $5.31. So basically, they're like dollar 86 lower, $1.86 lower, so like more than 20% lower than they were 90 days ago. For the next year, they will also lower, not by that extent, but a little, but still, we see that the expectations were lowered. But if we look at the price of Nvidia, let's say if you look at the price, we see that when matter of fact, I hold the stock and I just bought it around 130 something, and this company was 130 something dollars when this warning was announced, right? We can probably see it like in a graph. Hold on a second, 6 months. So we can see, for example, the company was 160, and then it fell to 138. That was the time when this warning was announced. And you see, after the warning, the stock just went straight up from 138 to 189, went up $50. So I'm holding this company. I'm benefiting from this from this irrationality. I'm benefiting from that, but I can tell you that the market is manipulating, because if you look, for example, in a smaller company which belongs to the small cap, to Russell 2000, for example, the company like SGH, this is a semiconductor company that recently announced, also like made a warning. For example, we can see the same picture on this company. We look at the analysis, we look at their earnings expectations, and we can see similar thing from little bit worse, from 688. We can see it's like more drastic actually reduction, but we can see that this company just went down from being like $50. uh, Hold on 1 second, summary. We can see that this stock during the 1 year period, it went down from being like $50 to $20, so lost more than a half of the value. So and this company is not going higher, so it's just standing lower, and that's it. This company is like it's a regular company which is going down after the earnings cut. After the earnings cut and lowered, the company is going down. The company like Nvidia, this is like the company that the big guys hold in their portfolios, and simply those guys don't want to sell, so they just simply don't sell the stock. And if nobody sells the stock has no way to go other than up, and the stock is going up, leaving to expectation, and you can really see that there are more buyers than sellers. And simply like even like when the market like falls, like some days when the market falls, but the last time I saw the market falling more than 1%, it was back in March, and it was like a very short-lived downside, because it was only for 1 day. So we see that starting from January, the market have very little down, a very little number of down days, and most of the time the market is going up. But at the same time, the market breadth, so which is measured by new highs versus new lows, the market breadth is already like going down. So it's because if you're looking new highs that are made, like it's not that many of them. So because the stocks are tired to go higher. At the end of my presentation, at the end of my webinar, I just want to show you a few things that I use during my research, during my analysis. It's a filter that I develop. It just takes a little time to download. So this is a filter that I developed myself. This is a filter similar to FinViz, but it has a lot of interesting things that helps you to identify the right stocks. So let me show you just how it works. Let me just make it change the language because I work with Russian audience also. Let me just all right, let me just show you what I do with this filter. So, all right, so I have things that I most of the time look at. It's Zach's rank. So Zach's, I can just simply move the flag, make it English, so it will be more convenient to you. So now we have all in English. So Zach's rank, there is a site called Zachs.com. So it ranks all the stocks from 1 to 5. 1 is a strong buy, 5 is a strong sell. So like I tell you, whenever I invest, I buy stocks and I short the market. So whenever I see the market is going lower, I'm not shorting a singular stocks because it's very dangerous, because when you short the stock can go up anytime because the stock can become acquisition target, or the stock might come up with some new products that might cause its way up. Like I can show you, for example, the company like MDB, that I'm shorting this stock, right? I'm shorting the stock all the way from 149, right? And the stock is up $4.66 today. So, right? So I'm losing like 3% on my, like I showed it, like I told you, on 149. I could cover it yesterday at 131. Yesterday stock was trading at 131. And even today, today it was trading at 131, right? So I could cover it today and make like $18. But the stock is up today. I didn't want to cover because I thought I have more potential to make money on the stock. But today, the news comes that MongoDB makes a partnership with Google. And of course, when the company starts working with Google, it's just positive, and it shows that the big ones acknowledging their products. And we see that the stock is up $4.88 at the day when the market is generally down. So this is like the risk that you have when you're shorting the stock. But when you're shorting something like ETF, like SPXS, this basically direction daily 3x to S&P. We see that S&P 500 is down 52 points of a percent, right? You're making, like when you invest in this ETF, right? So you're basically making 3 times 3x of the fall of the S&P. S&P down 52, so you're making like 1.43%. Actually, you have to be making 1.56%, but you're making a little bit less. But you're still making money because you are buying the ETF. But if the market will be down 2%, you'll be making 6%. So this is a way for you to hedge your long portfolio and to make money when the market is falling. There are other instruments like SQQQ. This is like to short Nasdaq, to short the technology. This gives you like 3 times what the Nasdaq is down. So, and there are many other instruments when you want to short, for example, when you want to short financial stocks, when you want to short retail stocks, when you want, for example, to short oil, when you want to short gold, and many others. When you want to, well, let's say, if you want to long volatility, for example, there are instruments like UVXY. When you want, for example, when the market is falling, for example, today UVXY is up, right? Up because market is falling. There is fear in the market. When the fear in the market, volatility goes up. So this is like derivative of VIX. VIX, we know it's like fear. It's market fear. And when the VIX go up, like it went back, like in December, we can see that this thing, if we take like 6 months and look at it, we see in December this thing was $86. So it was like twice as higher than it's compared to what it's now, right? So, but volatility instruments are not good to invest because they only work for a short period of time when market is falling. So it works on extremes. But the better ways to play market short, like I show you the first instrument, SPX short, this is like the best one. All right, going back to the finding a good stocks. For example, like I told you, ZAX ranks stocks from 1 to 5. 1 is a strong buy, 5 is a strong sell. So you can bet that the strong buy stocks are doing better during the any time than the strong sell stocks. Strong buy stocks are the stocks that really showed good earnings, that show good dynamics in their profits, the stocks that are showing the rise in their profits and their sales and profit margins. So if you select the stocks that have ZAX ranking 1 or 2, those would be the good stocks. And for example, if you're considering like 16 years period of the stock market, over this period of time, for example, the market was returning you like 8% on average, and the stocks that were ranked by ZAX 1 and 2, they were returning about 22%. So they're returning almost 3 times better than the market itself. So ZAX rank 1 and 2. The other thing that I'm using, ZAX VGM score. VGM stands for value, growth, momentum. Value gives you undervalued stocks, growth gives you the stocks that are growing, and momentum gives you the stocks that's on the uptrend. So we are taking, like, it's also ZAX ranks VGM score from A to D. We are taking A and B. So A and B, those are the stocks that's basically the good stocks, right? Also, I can also add some things like accumulation strengths, the right industry. For example, there are 300 something industries in the market, and if you invest in the top, let's say 30%, you will have better chance to make money. How the industries are identified? For example, right now, the top industry, if you look at the zax.com, just too many services are working right now, and it takes time. I just want to show you what is the top industry right now. So if you just if it's a paid website, I have the gold services with that, and if you just go to zax industry rank, we will find what's are the top stocks according to their rank. And the top stocks are the companies that's like in top industries. And the top industries, for example, right now is mining iron. There are 2 companies in this industry. The second top industry is electrical utilities, then thermal products, programming and logic, and metal products distribution. So we see that with the Chinese conflict coming to an end, probably there will be some compromise reached between US and China. A lot of mining and iron companies, they're benefiting from that. And that we see that those industries are like in the top, let's say 30. So if we look at that, and if we just in the industry rank, if we'll take the companies from 1 to 30, some our 30 top industries, we will have a better choice of making money. Also, what I'm considering, I just want to take the stocks whose Petrovsky score is 7 to 8. Petrovsky score is an indicator which measures companies' performance, like something like growing profits, growing sales, growing profit margin, lowering debt, and for example, return on equity is growing. So the nine parameters. And if 9 out of 9 parameters are met, the company has Petrovsky score 9, which is the highest. I am looking for the companies 7 and 8 because 9, there are only just few companies in the universe. So we'll take companies 7 and 8, and if we just do search, we will get, let's say, we got only like 7 companies from the entire universe of 7,000 companies. We got the 7 companies that I call them perfection. That's a perfect companies. 7 companies. That's a perfect. And now you can look at the charts. You can look at those companies like in other ways. For example, I show you what other things we look at those. We look at when we look at those companies. So PE ratio, we see like, for example, the first company has pretty high PE ratio, 62. I would probably like take this company out of this list because a little bit high PE. Then we go to valuation button, and we can see things like fair value, its intrinsic value, so how much this company should really worth. It's like we just added this, but I'm not really looking at it. PE, price to sales ratio, price to free cash flow ratio, and PEG ratio. PEG ratio, as you probably most of you know, It's PE divided by expected 5 years growth. By expected 5-year growth. So I'm looking for the companies whose PEG ratio is lower than 2. So we have like 1, 2 companies with 2, like under 3 we can even take. So those companies are all good. First, second, third, we go like to financials, and we're looking to the things like dividends. We're looking to return on equity, return on assets, and actually looking to the return on equity, and I'm looking for the company whose return on equity is higher than 5%. So basically, we have 1, 2, 3, 4, 5, 6 companies with return on equity higher than 5%. Return on equity is actually profit divided by equity in this company. Next button, it's performance. Performance show us how the stock performing for the week, for the months, and for the quarter. We see that all of those 7 companies, except the last one, they all up for the all 3 periods of time, right? So this is important for us. So it shows that the companies are growing, so they're in an ascending trend, and probably their chart is looking good. I can assure you. The next thing is technical. Technical, it shows us support, resistance, and very important parameters such as accumulation strength. Accumulation strength shows if there is institutional buying, institutional interest. If we see something like 212, it's pretty high. The highest of like 248 is pretty high also. Those 2 companies, PCMI and ACIW, show accumulation strength, show institutional interest in those companies. RSI, we see overbought if either the stock is overbought or oversold. And an interesting parameter called Sharpe Ratio. It shows us the risk of investing in this company. If we're selecting the company with the highest Sharpe Ratio, it means that they have a lower risk in investing in this company to achieve our goal. For example, 15% Sharpe Ratio for the company, it's PCMI shows very good potential in this company and very low risk. And the last thing that we are looking at is analytics. It shows us short float of this company. It's also very interesting parameter. So whenever I look at the company and see short float over 10%, it's kind of alerting me, because I see that some people are expecting the continuous fall on this company. So I'm actually trying to find the companies with a short float under 10%. But to tell you that the company like TWLO, which went up 4 times, this company had one of the highest short floats in the markets. It had short float over 60%, but this company still went up because those people who were short and they were wrong, those people had to cover. So once again, industry rank. So those companies have a nice industry rank, and those companies have, like I mentioned, Zacks rank 1 and 2. Only the last company has Zacks rank 1, which is strong buy. Zacks VGM score, all of them have A and B. And the last parameter is Petrovsky score, as I mentioned. So 8 is pretty high, and there are like only 2 companies have 7, 4 companies have 8. So those are the companies that are very strong, and those are the companies I have about like 4 of them in my portfolio, and those how I get the companies that I recommend to my clients, that I recommend to put those companies in my clients' portfolios. Those companies, you can write them down and you can follow them, and you will see that those companies will behave, they will act better than the market. So I am pretty much done. Now I will be answering your questions. For that, I will have to go to Facebook, and I will see probably some questions. Let me see. If you have some questions, then please write them down, and I will try to answer. But I don't see actually any questions. One second. Okay. Okay, I don't see any questions, so I will give you a few minutes if you still have any questions. And please think if something you want to ask me. And if you are, don't hesitate, and I will answer definitely. There is no question that catch me by surprise. I can answer any questions you'll have, and don't hesitate, and I will give you a few minutes. Okay, so I have to continue my trading. I'm sorry. So if you have any questions, please write them down and I will be answering them. You can write me personally on my messenger and I will be answering your questions. Thank you for your time, and I'll be continuing to give you some signals, give you some advices, and hope to hear from you. Thank you for your time. Bye.